Can companies manipulate earnings reports for investors? Imagine looking at a company's financial report and wondering if what you see is the full story. Sometimes, companies can make their earnings look better than they really are. Earnings reports are like report cards for businesses, showing how much money they made or lost over a certain period. Investors relying on these reports to decide if they should buy, sell, or hold a stock. Companies might try to make their earnings look more attractive for a few reasons. They want to meet market expectations, which can boost their stock price. They might also want to qualify for loans or secure bonuses based on their financial performance. But not all companies are straightforward. Some may stretch the truth a little or even bend the rules to make their reports look better. One common trick is timing revenue recognition. This means a company might record sales early or delay them to make their earnings look higher in a specific quarter. For example, they might ship products before the quarter ends to boost sales figures. They can also manage expenses by delaying recognizing costs or spreading them out over time. This makes profits appear smoother and more consistent. Another way companies manipulate earnings is by adjusting reserves. They might increase reserves for bad debts or warranties to lower expenses in one period, then decrease them later to boost earnings. Changing accounting methods is also common. Using different depreciation or inventory methods can affect how much profit is reported. Sometimes, companies hide negative information deep in their reports or leave out important details altogether. Because accounting rules allow some judgment and estimates, it can be tricky for investors to spot manipulation. Many companies admit to managing earnings, especially to meet short-term goals. This can sometimes harm long-term value, even if it helps the stock price temporarily. For students learning about investing, it's important to look beyond the headline numbers. Check cash flow statements and notes for clues about aggressive accounting. Watch for unusual patterns, sudden changes in revenue recognition, or large one-time items. Comparing a company's performance with others in the same industry can also reveal inconsistencies. Remember, not all earnings management is illegal. Some companies do it within the rules, but it can still mislead investors. Being aware of these tactics helps you make smarter choices and avoid being fooled by overly optimistic reports. Always stay curious and question what you see in financial statements.